What's up people? It's your boy Maruko Georges, and this is Maruko's George Television, the home of African stories. Today we are going to have a very interesting conversation about insurance. I am having a panel here of very interesting people. They will tell you what they do. Without much further ado, let us introduce them. Welcome.
Yes, I'm Dr. John Karanja Mushonjo, work in Kisii, and an insurance consumer.
Hello, how are you? My name is Vincent Ogega. I'm a bank assurance officer. I'm an insurance professional.
I'm Nyachio Edith Nyakiraru. I'm an insurance consumer.
My name is David Lumumba Salasini. I'm an engineer by profession and a businessman. I am a consumer of insurance. I'm also an agent of insurance. Thank you.
Yes, good afternoon guys. I'm Eric Okari, a banker by profession. I facilitate insurance through asset financing.
Good afternoon everyone. My name is Dr. Bosibori Ondari. I'm an insurance consumer.
Hey, I'm Samuel Mbuvi. I'm a DJ. I go by the name DJ Loops. I'm an insurance consumer.
Hey, good afternoon guys. My name is Mukaya Wycliffe Mbai. I'm the general manager at Everb Insurance Agent.
Good afternoon guys. My name is Arjun Kerato. I am a sales agent and I also do online academic research.
Good afternoon guys. My name is Dennis Nyaure. I'm an economist by profession and a unit manager in one of the leading insurance companies in Kenya.
Habari. Kwa majina ni Kusko JB. I'm a presenter, an artist, an MC at Kitembe TV and Arena Media, and I'm an insurance consumer.
Good people, welcome once more. This is Maruko's George Television, the home of African stories. And as I promised, we are having a conversation about insurance. We want to demystify some myths about insurance, want to educate and also disseminate information so that when you make a decision from a point of information. Number one, I want to say in short words what insurance means. Insurance basically is the transfer of risk from one entity to another entity by payment of premium. Meaning, a risk is when you stand a chance of losing something. You have something of worth and you stand a chance of losing it. We classify that as a risk. And basically, risks of financial nature or life nature. Meaning that when you lose that thing, you either lose money or you lose a life. So you transfer that risk to an insurance company by payment of premium. And in insurance, we have different parties. We have 4 or 3 parties in insurance. We have the first party, second party, third party, and the fourth party. So the first party in insurance is the person who is buying the insurance. Second party is the insurance company who is taking the risks which is being transferred from the first party. The third party is another person who is involved in the process of a loss. For example, if you have a motor vehicle, you are a first party, you purchase insurance from an insurance company which is a second party, and if that motor vehicle is involved in an accident by hitting somebody's property or a human being, now that property or human being is what we call a third party. So basically that is insurance. And I have called here some partners in the insurance industry so that they can tell you how you can be able to place or you can transfer risk from one party to another. In insurance, the most important aspect is that payment of premium. Transfer of risk involves that you incur some cost so that the other party will guarantee you some security in case you lose whatever you had that of value. So today I want to talk about premium. And the premium is paid in different modes. You can either pay upfront in cash or check or PDQ, or you can be financed. So this financing of premium is a facility which banks offer called insurance premium financing. And that is why I called one of the bankers who is in charge of insurance premium financing to talk to you about that facility and how you can be able to access it. Kindly help me welcome Vincent on board.
Thank you again. Welcome back. As I said, my name is Vincent Ogega. I'm a bank assurance officer and an insurance professional. I'm going to talk about IPF. It's called Insurance Premium Financing in long. So this is a method, one of the methods we use to pay insurance. In insurance premium financing, we only need a customer to fill a proposal form and sign it. From there, we have to pay premium in 10 installments maximum, and also we have a minimum of 4 installments. So you can make a decision if you want to pay in 10 installments or 4 installments. When you pay in 10 installments, the rate is 4.918%, and when you pay in 4 installments, the rate is 1.622%. So the longer the period, the higher the rate, and the shorter the period, the less the rate. So we'll sit down and discuss and agree on how you want to make the payment. Insurance premium financing is a very convenient way to make payments instead of struggling to make a one-off payment. So we highly encourage our customers to pay through IPF form so that they can remain with something to run their business. Because at the end of the day, as a business person, you need cash to run your business. So IPF gives you time to make small payments over a longer period so that you have enough to run your business. Thank you so much. Back to you, George.
Thank you, Vincent. Thank you very much. As I have understood from Vincent, is that you have an opportunity to pay your insurance premiums via installments. That's the facility called Insurance Premium Financing, in short IPF. It is offered by most of the commercial banks in Kenya. So once you purchase insurance and you realize that your premium is a bit high, you are able to go through IPF, and as I heard, the rates are very low, between 1.6% to 4.something%. So thank you very much. Again, insurance is about property, it's about having something of value and insuring that thing. And also, I have one member here who works with these commercial institutions, the bank. He is majorly concerned with financing assets. He's going to tell you about his facilities and how you can go about acquiring them. Help me welcome Eric Okari.
Good afternoon, guys, once again. As I said, I'm Eric Okari. I'm a banker by profession, a credit officer. I facilitate asset acquiring, asset financing. I want to talk on asset financing. On how customers acquire assets. You find a businessman wants to acquire an asset. Either he has enough funds, he doesn't have enough funds. Whoever who has enough funds, he doesn't want to commit the funds to purchasing the asset because it may affect his work cash flow in the business. He comes to the banks to be assisted so that the bank can pay part of the financing to acquire that asset. Mostly banks do asset financing from up to a maximum of, most of the banks do up to a maximum of 95% financing. This is a higher purchase agreement whereby the bank cannot commit the whole amount of the asset, so the customer must contribute a certain percentage. So most of the banks accept up to 5% as a minimum from customers, so that it is a commitment to you owning this asset. The criteria for you qualifying for this asset financing, you must have good bankings. And the kind of assets that the banks mostly finance are vehicles, machineries, medical equipment, and the period that is paid for a facility depends on which kind of asset is being acquired. For machineries, generators can go up to 24 months, but for motor vehicles, mostly trucks, they can go up to 60 months. But for heavy trucks like tippers, most financial institutions give up to 4 years because of the depreciation rate. So if a client or a customer wants to purchase an asset, you don't need to commit most of your finances to purchasing that asset because you need this money to purchase stock or to do other activities in your business. You come to the financial institution, any financial institution, most of them offer asset financing. You make an arrangement by filling an application form, then the bank can finance a certain percentage according to your agreement with that financial institution. So what I can encourage customers is that don't commit most of your cash flow to purchasing an asset. The bank can come in, put some finances into your purchasing of the asset so that it can allow you use the kind of money you have in your business to purchase stock, to run your business as you pay the loan in installments for a longer period, which will allow your business to grow. Thank you very much. For more information, you can contact us privately. Thank you very much.
Okay, Edith here speaking. So Eric, I got a question for you. Do you also give loans to these people who have small businesses, that is hustlers?
Yes, thanks Edith for your question. Most banks finance small businesses. There is a criteria that is used to measure whether your business can be financed or not. Most banks don't support loans to businesses that are startups, that are starting. They lend to businesses that are more than 1 year old. So that is the first criteria. So as long as your business is more than 1 year old and you are banking with a certain financial institution, you qualify for a loan. Currently, most banks are changing to supporting youth because most of the youth nowadays don't have securities. We don't have titles, we don't have motor vehicles to give us logbooks as securities. So banks want loyalty to them so that you bank fully with them. Your statement is okay. When your statement is okay, now we have some facilities which are unsecured, mostly to cater for the youth. So that you walk in because of your relationship with the bank, through banking, you can get a loan. Yes, as small businesses, you can get loans from banks. Thank you very much, Edith.
Okay, so mimi ni DJ. Nilikuwa nataka kujua kama mnaweza finance nipate equipment za ku DJ. And then kama mnaweza insure, kama zinaweza kuwa insured na your bank.
Yeah, thanks DJ Loops for that question. Yes, banks finance equipment, but there is a minimum of an asset to be financed in terms of value. If your machine or your equipment costs over 300,000, banks can come in and finance that one. What you need to do is to bank with the bank, have a statement, then get an invoice from whoever who is selling to you those equipments. You present that invoice to the bank will finance a percentage of that invoice. Let us say, for example, it is the cost is 300,000. You can have a commitment. Mostly for equipment, we take 40% contribution from you, so that we come in with 60% as a bank. Most of the equipment that we finance, we are interested in the insurance. Reason being, if you lose them, the bank doesn't go into a loss. We can be paid by insurance. So that the part of insuring, I leave it to the insurance experts. But we are interested in that insurance, and we send you to insurance companies to get that cover for your equipment. Thank you very much.
My name is Cusco once again, and my question is that can I use my M-Pesa statement to get a loan from your bank? And my question goes to Eric.
Thanks, Cusco, for that question. We use M-Pesa statements to process loans, but there is a condition. You know, we want to start a relationship with you. So during application and processing of your loan, we will accept your M-Pesa statement, but we will leave you a condition to start banking with us immediately. The reason why we are taking M-Pesa statements currently is because the economy is moving to mobile. So we can't force people they are using M-Pesa as their banking solution. So we'll take that statement. But for our partnership to be okay, you have to start signing with us. We'll give you a condition after discussing that law. Thank you very much.
Naona conversation inaenda poa. Tunashukuru sana kwa wenye mna watch. Tunashukuru sana kwa wenye una participate. Hizo maswali ni poa sana. Conversation ni about insurance. Conversation ni about business. Conversation ni about finance. Na unajua insurance is a financial service. Na unajua tuko hapa kuinua wasee, kujenga watu, kuwapatia information. Ndiposa wakimake decisions wakwe wako na information. Yani you make a decision from a position of information. Na hii insurance watu wanauliza ni pesa ngapi? Sasa kuna kitu tunaita rates. That property yako ikiwa ni value, kuna ile rate tunatumia ku calculate premium. For example, if you have a property worth 1 million, ni pesa ngapi utalipa nayo insurance? Na sasa nataka kuita ndugu yetu mmoja mwenye amefika kama amechelewa, at least ajaribu kuongea briefly about rates. Na kwa sababu watu wengi interest yao ni motor insurance, aongee hizo rate za motor insurance. Help me welcome Evans on board.
Okay, my name is Evans Birundu, and writing. Sorry first for the being late. I'm going to talk about rates in insurance. We have different kinds of insurance. We have motor and non-motor. But basically I'm going to talk about motor insurance, whereby motor is also classified in different categories. We have commercial vehicles. We do have private vehicles. I'm going to start from private vehicles. Private vehicles, we have comprehensive and we have third party. Mostly I'm going to talk about that comprehensive. In comprehensive, we have two categories, whereby that we have motor park insurance. We also have general insurance. In general insurance, we also use what we call sum insured, whereby we apply as per the sum insured of your vehicle. From 400 to 1 million, we use 4%. Above 1 million, we use 3.5%. Above 1.5 million, we use 3.25%. That's about motor private general policies. We also have motor park, whereby it's an enhanced policy. We use 5%. That's generally about motor private. I'm going to motor commercial. We have general cartage and on goods. On general cartage, we use 4.75%. On goods, we have 4.5%. Those rates are, we don't include them in excess protector. We have what we call excess protector. Excess protector is an insurance which is added to the rates that we apply to enhance your policy. In case of a claim, you are not asked for an amount on additional what you have insured your car onto. Minimum, we have 0.5%, minimum 20,000 on both policies, that is general cartage and on goods. And the rates actually, which I've already told you about motor insurance, are applicable in one of the insurance companies in Kenya, that is Kenya Orient. And we are happy if you can for us and come to our insurance. We'll be happy to serve you. Thank you.
Once again, thank you for the opportunity. My name is John Kerato. My question goes to George Maruko. I want to understand the difference between on goods and general cartage. Thank you.
Asante sana John, thank you for your question. What is the difference between own goods and general cartage? Simply, that means if you have a motor vehicle and it's carrying goods. So, there are two types of goods. The first type of goods are your own goods, that you have a shop or you have a business. You are going to purchase your goods from a supplier. You are carrying those goods from that supplier to your shop. That is own goods. You are carrying your own goods as a businessman, as the person is insured. And general cartage means you have a motor vehicle, it's a lorry or a pickup, and the people are contracting you to carry their goods from wherever they buy to their shops, or from their shops to their customers. That's the difference. That in own goods, you are carrying your own goods, and in general cartage, you are carrying for other people for a fee. That's the only difference.
Okay, my name is Dennis, and my question goes to George Maruko. I want you, George Maruko, to explain the audience what is the meaning of sum insured and excess protector.
Sana Dennis, thank you for your question. Actually, you have two questions. Number one, you want to know what sum insured. Okay, we said insurance is the transfer of risk from one party to another via payment of premium. So when you insure property, there's that amount that if you lose that property, you stand to lose that amount. Let's say 1 million. So that 1 million is what we call sum insured. And as we said, that is what we use to calculate how much you will pay to the insurance company. So it's the amount you stand to lose if you lose that property. Basically, that is it. And then excess protector. Excess protector, number one, I will explain what excess is. This is how we classify excess. Insurance companies do not insure property 100%. They insure up to either 95% or 97.5%. So that they let you self-insure 5% or 2.5%. This is because they want you to be careful, so that you will put measures not to lose that property. And because of that, when there is a loss, they share the loss with you. They pay that 95%, you pay the 5%. But because losses occur when you have not planned, they are like accidents. So what happens is, they also tell you to protect that excess, that 5%. So you pay an extra fee so that when there is a loss, you do not incur any cent during a claim. So excess protector is ensuring that excess, either 5% or 2.5%. I hope that answers your question.
Yes, I'm Dr. Karanja, and I have a question that goes to George. Now, in my line of profession as a doctor, how can I be insured? Thank you.
Asante sana daktari for your question. You asked whether we can be able to insure your profession. And you know, in your profession, as in medicine and other professions, there are those errors of omission and errors of commission. So a client can sue you and you are liable to pay. So we have a policy which we call professional indemnity, so that we insure you, we insure your profession, so that when such an error occurs, whether of omission or commission, and you are taken to court, the court awards some amount, the insurance is able to pay on your behalf. So yeah, we have that policy. Thank you very much for following this conversation. Hope imekujenga. Subscribe, hit the notification bell, you don't miss any videos. And this is Maruko is George Television. And if you value it, insure it. Yes, if you value it, insure it.